Welcome to Law Easy. My name is Martin Schenkman, and I'm joined by two colleagues, Jonathan Blottmacher and Thomas Tietz. Welcome, Jonathan and Tom. And we're going to talk about really one of the most critical topics to all of estate and financial planning, grantor trusts. Please keep in mind that the video clips on Law Easy, including this one, are for educational purposes only. Don't take any action without consulting professional advisors. Tom, just give us an overview on slide 3 of what a grantor trust is and why it's so incredibly important.
So a grantor trust, as it says, is one of the foundations of modern estate planning, and there's a couple of reasons why. The way for income tax purposes, the grantor trust is treated as if the grantor themselves continue to own the assets. What this means is that any income that's attributed to assets that are held within the trust are reported on the personal return of the individual that established that trust. So the income that is generated within the trust gets to grow inside that trust, essentially tax-free, because the individual is paying the tax for the trust. The tax is still being paid, but not by the trust. There are two effects of this. The first effect is that any growth within the trust gets compounded because it's not being reduced by paying taxes on it. And as Einstein told us, compound interest is the eighth wonder of the world, basically. The second effect of this is that the assets continuing within the taxpayer, the grantor's estate, are reduced because he has to pay, or she has to pay, the taxes on the assets that are held within the trust. So there's a double effect of that. Another effect is that the grantor is able to sell assets that are remaining in the grantor's name to the trust without having to have any gain on that. So any income or any interest that is paid by the trust, if there's a promissory note, the taxpayer does not have to pay income on that. And it's a great effect for the taxpayer. It also allows, as it says here, for grats to make annuity payments in kind without any income tax recognition. So if the taxpayer creates a grat that's grantor as to the taxpayer, and you need to, at the end of the trust, pay back in kind, anything that's remaining in that grat, the grantor retained annuity trust, is outside of the estate, but there's no sort of gain, even if there's highly appreciated, while that asset is held within the grat. A final point is the grantor is able to substitute the assets that are held within the trust if they're highly appreciated. So for example, when the grantor is reaching the end of their life, if the assets that are within the trust have appreciated while they're in the trust, that grantor can substitute those assets with cash so that the highly appreciated asset is brought back within that taxpayer's estate. And when they pass away, under the current tax rules, they will receive a step up in basis on those assets. So there was growth outside the estate because it was within the trust, but then at the end of the taxpayer's life, they can bring those assets back into their estate and receive a step up in basis upon that appreciation.
Okay, and Jonathan, what might our friends in Washington have in store for us on these wonderful grantor trust benefits that Tom just described?
Well, right now, the IRS has released its 2023 business plan, and not surprising, there are many things.
We lost our audio with you.
Those is to say they're going to not allow an income tax-free step up in basis with respect to assets inside a grantor trust when the grantor dies. You see a reference here to an article which Mitchell Gans and Hugh Jacobson and I wrote for the Journal of Taxation in September of 2002, in which we said, if by reason of the grantor's death, then gross estate, nonetheless, you'd get an income. Everybody in the world said, you guys are absolutely crazy. In fact, the editor of the Journal of Taxation said, Jonathan,
you're fading out, Jonathan.
We published your first book. We published over 50 articles you've written, but now you have gone too far. 10 minutes later, he said, this will be the most exciting article we will have published in a decade. And indeed, there is a private letter ruling that came out in 2012, which said, yes, when the not included in her gross estate, you get the tax-free step-up in basis. Now, there have been legislative proposals. Bernie Sanders did one in his thing, you don't get it. But nothing has been enacted. Secretary of the Treasury Janet has basically said we need to do something about it. So now it's under the business plan. And the indication is they will deny the income tax-free step-up in basis with respect to any assets in a grantor trust that are not included in the grantor's gross estate. So you can watch out for that. I don't know how they're going to do it because I don't think they want to give up the fact that, as Tom indicated, it's been the long time position of the Internal Revenue Service that assets in a grantor trust are continued to be owned for income tax purposes by the grantor. And I won't go through the details, but I'm not exactly sure how they're going to try to stop people from taking the position that there's a tax-free step-up in basis with respect to assets in a grantor trust when the grantor dies, even if those assets are not includable in the grantor's estate. As I indicated, there are many, many proposals in Washington dealing with grantor trust. And remember, it is basically the chassis upon which most modern estate tax planning strategies are built. So the point is to take this home is do your planning now, especially now that you can use grantor trusts in very favorable ways.
Jonathan, many people are going to say, well, golly, the Republicans control the House. How could this ever get enacted? They're never going to permit it. Comment, thought?
Well, Marty, there are a lot of things in Washington that happen which you don't expect. And that's because, Marty, and I hope I'm not offending you and Tom and the members of our audience, but everything in Washington is for sale. It is only a question of price. Remember back to 2012 when it was already in the legislation that we were going to have the estate tax exemption drop from $5 million down to $1 million. It was already in the law. But John Boehner, the head of the House of Representatives, Mitch McConnell, the head of the Senate, and Barack Obama got together like a bunch of little boys in a room trading baseball cards. And somehow that Mitch McConnell and John Boehner got to keep that $5 million exemption because they traded with Barack Obama for something else. So don't think it can't happen. And the time to act is where it's clearly available as it is right now.
So in contrast to what some people think that nothing's going to change, you never know. I want to thank Jonathan and Tom. Thank you for joining us. And please, again, keep in mind that the information on this video and all of Law Easy are for educational purposes only. Good luck, everybody.